So, welcome. Thanks for joining this session with James and I. We are going to be talking about international expansion or international tax risk more widely today. For those who don't know us, I'm Steve. I head up the high growth team here at CP. In short, we're a team focused on the venture space, look after hundreds of scale ups in the UK in terms of their overall advice and requirements in the accounting space and tax space. I'm actually an audit partner by discipline, so I see a lot of these issues that we're talking about kind of across a wide amount of the companies in the portfolio. And James is a tax partner, very famous tax partner, as most people have either heard of him or seen him on these webinars. The amount of people I speak to have said, "Oh, I've seen James on the webinar." So, James, do you want to do a quick intro and we'll kick off?
By all means. Hi everyone. So James, as Steve said, tax partner here. Don't know if I call myself famous. I think if I ever say that out loud, you're able to shoot me. Just a tax partner, head of tax for the THG team. So yeah, we're going to cover international tax today. But anyone that's ever spoken to me before will know that I always contextualize things not only in terms of what companies are thinking about doing now, but in the wider context. So how does your international fit into basically creating a tax structure that works for you, which therefore creates tax efficiencies, but with an overarching view about thinking about what does that look like in terms of the future plans of the business, both in terms of commercially, but in terms of future events, either be that kind of trade sales or liquidity events, and then preparing for those. So my experience obviously is I've done a shed load of internationalization over the years, but I've done a huge number of deals. And this is one area that we'll cover it today, but that we see come up again and again, which is where are the sensitivities when companies are fundraising or going through an exit or IPOing, and how does international tax play into those? So I think whilst there's a number of areas that we're going to address, the point that I'm going to raise each time is, well, the so what, right? And what are the contexts of those? And we can look at that through the lens of either from a tax authority's perspective, we can look at it through the lens of, say, from Steve's perspective, from an audit perspective. But again, contextualizing in what can this mean if you are then going to subsequently be diligenced by a business, or be diligenced as the business goes into some kind of event. So that's kind of the backdrop of what we're going to cover today.
Cool. Just a quick hygiene point. I'll be monitoring the Q&A. So if you want to drop questions in as we go, I'll try and weave them back into the way in which we're going to run the session. And if I don't bring them in straight away, it's because I know they're coming at another point, or it'd be easier to cover at the end, etc. So, but do drop them in as we go along. We normally run these just as me kind of asking James some questions just to give us a bit of structure. I'm just going to screen share. We're not going to use slides, but I will just quickly bring this up, which I'll just come back to at various points so everyone's clear where we are in the session. Essentially, there's 5 sections that we want to cover, and they range from kind of some of the early initial considerations for interactions with another country, in effect. Some of the things in between setting up in another country and areas of how to set up, and then all the way through to some transfer pricing considerations and things like that once you're got fully operational within a jurisdiction. As James said, we're working with businesses that are doing this from scratch, going into different countries, or we're doing this with businesses that got a fully baked international model and structure and thinking about where the risks sit in that structure. So I will take this down and we'll kick off. But first point really is, James, where do we start? Where do you start when you're looking at talking to a business that's looking at international aspects of their future strategy? Where do you actually start with assessing the risk of trading in versus trading with the starting point?
The irony is, so you're assuming that we're starting with a blank canvas, that someone's thinking of coming to us at that point. The reality is that quite often we sit in a situation where companies come to us and say, we've kind of not really been closely monitoring our international footprint, and therefore we don't know if we've got exposure in multiple countries, right? Or they may have certain thoughts about setting up in countries, or they might have set up certain entities or branches. But let's assume today that we're starting with a kind of blank canvas, right? And you're not then having to kind of unpick it, but it's going to be the same points that we're going to raise. So this first concept is, and I'll give an example. Let's just assume for the purpose of today that we've got a UK HQ business. So that's where the fundraiser's gone into, that's where we're developing the tech, whatever that might look like. The main critical mass of individuals are there in that UK business, right? So very simple plan. When we're starting to think about internationalization, and I'm going to use an example of the US throughout, but it can be applicable to any country. And we'll look at some of the nuances where that might be applicable as well. So when we're thinking about kind of setting up shop in the US, we've got to basically work out fundamentally, am I creating a taxable presence outside of the UK? So in the US, in my example. How do I trigger certain taxable presences overseas? You might refer to it as a permanent establishment nexus, and we'll come on to that later on. But the first point that we always address is actually from a direct tax perspective, we'll look at both direct and indirect or VAT sales tax as well, briefly, is fundamentally, am I in a position where I'm trading in a country or am I trading with a country? Now, it seems like a really simple concept when we talk about international tax, but it is the fundamental of one of the things that we look at. So when I'm trading in a country, so the example with the US again, is that fundamentally I'm sitting in a position where I have critical mass in the US. And critical mass can mean boots on the ground, I have an office, I have salespeople, I have individuals that are in the country that have the ability to negotiate, conclude, and sign contracts on behalf of the UK business, right? So it's very simple, but if I am trading in a country, I am likely to create what's referred to as some kind of taxable presence in that jurisdiction. And we're going to cover the different ways that you can do that later on. So if you've got people there and there is a level of permanence attached to those individuals being in country, it's likely that you are trading in a country and therefore need to think about actually setting up some form of operation, which might be a branch, it might be a subsidiary. The other side of that is, am I trading with a country? So let me give an example to explain that in a bit more detail. When I'm trading with a country, I have no boots on the ground there. I've never been there. But the example that I've got a UK business and say a US customer or potential customer has reached out to me. I've got my sales team in the UK. I've got critical mass in the UK. I don't have anyone in the US. So they've reached out to me and said, look, we'd like to purchase your services or your product. We'd like to have a discussion about what that would look like. If I engage then with that US entity and I serve a contract from the UK business, I should be recognizing the revenues in the UK business. And obviously the cost base already sits in the UK business. I'm not trading in the US in any way, shape or form, but I am trading with the US. So from a direct tax perspective, I just basically need to go, well, actually, I'm not creating a taxable presence in that regard. And therefore, it is absolutely fine for me to continue trading through my UK business, right? Very simple concept. There are slight nuances when we look at indirect taxes. It's not quite as straightforward when it comes to indirect tax. So given that example before, if I am trading with the US, I don't have boots on the ground. I can basically ensure that the revenues are going through my UK business and therefore any tax attributable to it will go through the UK. From an indirect tax perspective, I will still need to think about, so when I charge it from the UK, it'll be outside of the scope from a VAT perspective. However, I need to think about the attribution of sales tax on a state-by-state basis. So there are kind of nuances and complexities. You just need to think about the differences between direct and indirect taxes. I think we're going to concentrate more on direct tax today than indirect taxes, but just want to flag that as an area.
And in terms of, I guess, the next step on from that, obviously everyone talks about permanent establishment and how that can be created. But have you got kind of some main trigger points you can talk through in terms of how people should think about permanent establishment, just so they can almost make their own assessment informally as to whether they're getting to the line on whether permanent establishment has been created?
Yeah, absolutely. I think there's a couple of ways that we can look at PE and assess the exposure and potential risk. So there's a kind of an application of guidelines that are referred to as the OECD guidelines that basically give an overview as to how they consider the application on a global basis of how you're triggering permanent establishment. And generally, what we do is we do an analysis of the OECD guidelines to give a strong indication as to whether, there is likely to be a permanent establishment created in an overseas country. If there is still areas of concern and consideration, there are nuances and companies take their own views in terms of how the OECD should effectively be applied. It's also potentially sensible at times to then, if there is risk and exposure, to then think about taking local advice. So it can be a two-step approach. But generally speaking, the OECD has outlined 2 or 3 approaches that generally suggest that you do, or more likely than not, to have a permanent establishment in country. So they're referred to as agency PE, fixed place of business, and service PE. Let's go through each of those in turn. So an agency PE is where, say, you have an individual based overseas who habitually has the ability to negotiate, conclude, and sign contracts on behalf of the main company. So the UK company in our example. So you've got a US sales individual who is able to then go out, meet with customers, negotiate the terms of the contracts, conclude those, and then sign them. What we're saying here is that in that regard, that individual would have the ability to conclude and contract conclude and contract on behalf of the UK business. As a result, you are going to trigger a permanent establishment risk in that country. So if you look at it another way, the IRS would turn around and say, look, if you were to basically put all of those revenues through the UK business, the IRS, the US tax authorities, are not getting any kind of proportion of that potential taxable benefit in the US. And therefore they would say, look, we think that you are creating a taxable presence in jurisdiction, and therefore we would want some of the taxable income as a result of that. So I think the first point is, if there is any individual that fundamentally is in a position that can negotiate contracts, and that's with customers, it's not necessarily to do with purchases or cost base, then it's likely that you're going to fall into creating a taxable presence. The second one is then fixed place of business. Now, being honest, the tax legislation hasn't kept up necessarily with changes and the evolution of working practices. So for most tech companies, we're really talking about a fixed place of business at an office location. There are other criteria. So if you had a factory or some kind of facility plant, that can also trigger those. It's also worth noting as well that the application of servers in country can also trigger a PE risk in certain countries. But if you basically go, well, actually, we've got an office location, that's the main way of doing that, and there's a level of permanence attached to that office, then again, it could be argued that you're creating a taxable presence in country. Now, just to be completely clear, that's irrespective of who you're hiring through that office. Now, there has been recent case law as well around, does a home office constitute a fixed place of business? Again, there's uncertainty in relation to that. There's been a couple of cases that have been tried at court in terms of determining that individuals can trigger a fixed place of business through home office locations. But again, it's not something that's kind of set in stone at the moment. But I'd imagine that over the next few years, that's probably going to be more defined. And obviously, the tax authorities are looking at ways to tighten these definitions in more regard. So we probably just need to keep an eye on that. And if there are any other updates, we'll kind of obviously keep everyone aware of those as they play out. The third way of creating a permanent establishment is referred to as a service PE. So it's quite rare. It's generally where countries don't apply OECD. So for instance, in the Philippines, in Malaysia, they have this additional kind of PE test. It's not really applicable in mainland Europe or the Americas. But fundamentally, if there is a provision of services, either internally or externally provided, then again, there is a requirement potentially to register a permanent establishment in country. So just to recap, it's mainly if you've got a sales representative, a salesperson, and I know that we all define salespeople very differently. So it's very much about the ability to negotiate, conclude, sign contracts on behalf of the main entity that needs to be considered, fixed place of business and service PE. So if you there's a point here, which is, I think post-pandemic, we've seen a change in working practices, right? So we've either seen kind of hiring more on a global basis, because obviously it's relatively cheaper to hire people overseas than potentially in the UK now. But we've also seen a relaxation of working practices. And by that, what I mean is that we've allowed individuals who were in the UK to then go and move overseas and live there. So as a result, I think we've just got to be aware as individuals move overseas, we have to understand what their role is, what their obligations to the business are. Are they effectively salespeople? Where will they be working? Are they providing services, right? Fundamentally, they probably are going to be providing services. Now, whilst you need to think about this and assess those individuals, not only from a direct tax perspective, but from a payroll perspective as well, potentially from a VAT perspective or indirect tax perspective. These things all need to be considered. I think we're going to go on and talk about EORs in a minute, because I'm a big fan of EORs. I think they allow for kind of seamlessly moving into countries, but there are things that need to be aware, there are pitfalls attaching to them. My final point is that just because you have an individual overseas doesn't mean that you're creating a taxable presence in that country. There are certain exemptions that apply. So, for example, if you have individuals that are independent agents, so genuine contractors, then PE might not be triggered. But again, that will need to be considered. And there's also a kind of exemption in relation to what's referred to as proprietary auxiliary services, fundamentally, where individuals who provide kind of auxiliary services to the business don't trigger PE risk. Again, it needs to be risk reviewed to determine actually the extent and likelihood of creating exposure.
Yeah, just we have got a few consumer businesses on the call as well. Just in terms of businesses with physical product.
Yeah.
If there was warehousing of product in the US, for example, if it was even a third-party warehouse, does that constitute a fixed place of business for the UK entity, or is that?
It shouldn't. So you said the killer word there, which is third-party warehousing. Shouldn't. If it's your own facility that you've taken a lease over, then it's more likely that you are going to fall into that fixed place of business. But yes, I think there are certain exemptions that apply. Well, there are certain exemptions that apply when it's kind of third-party warehousing facilities that are being used. So again, it's worth having an awareness of it, and just, the point I would make is, like, let's say you do have a consumer product, it's likely that if you've got a warehouse facility, that potentially you have, sales and marketing people in country as well. So those might attach to that, and therefore you might need to think about, actually, are you triggering a PE? Maybe not through fixed place, but through the representative of salespeople in country. So it does kind of tie in together.
Just a quick question from Naheem on the meaning of EOR as an acronym. We'll come on to that now, because that's kind of the next section to some extent. Employer of record is the terminology there, and maybe just start off with a quick explanation of what that is, and then if we can get a little bit into maybe how we see them being used initially, and then how we see them evolving as a business expands internationally.
Okay, so an EOR or an employer of record, is basically where, let's say that you've got an individual that you want to employ in Spain. And fundamentally, the question that gets addressed at that point is, how do I, in inverted commas, employ that individual in Spain? So, they could be a fully independent agent, a contractor, and you would pay them on a gross basis. But if they're more akin to being an employee and you don't have, a local entity, you can't run payroll. So employer of records evolved really to help with rapid growth into countries, and basically ensuring there was a way that you could basically hire people in country and therefore pay them. So it reduces payroll risk in countries. We're going to come on to the risks that they present in a minute. But it allows for rapid expansion, right? So putting boots on the ground, getting people into country, making sure that the required obligations are done from a kind of hiring perspective, from a legal perspective, allows for these things to happen. And EORs are really, really good for that benefit. So that's basically the application. What happens is you engage, so the UK business will engage with an EOR provider. So you might have heard of Omnipresent or Deal as examples of those. And fundamentally what they do is you then have a contract, say, with Deal, and then Deal will then employ the relevant individual. Okay, I'll come on to some of the commercial aspects as well. I talk about a lot of tax, but I quite like the commercial overlay as well. So basically you have a back-to-back contract with the EOR provider who then fundamentally employs that relevant individual. And then, you know, they operate, you pay them, they pay the individual, they operate payroll. So in country, there is no kind of payroll concerns on the premise that say Deal are operating on your behalf. As I said before, it's really just kind of like allowing you to move very swiftly into country, not having to think about setting up a local entity or a branch, setting up payroll individually, which can be very costly. So that's the main reason people use them. They're used on a global basis. And I think one of the criticisms that I hear for the use of EORs is obviously they're quite expensive. So the question I get asked quite a lot is like, when is the right time to move from EOR and move away from it? And the general rule of thumb is where you've got somewhere between 3 to 5 individuals in country, the opportunity cost of hiring them through a EOR is outweighed by setting up a local entity, which might need local kind of, you know, accounting and tax services and running payroll. But that might become a time when you need to. But you also then need to assess, and this is the point I was making, couple of risks that present through an EOR is that an EOR, and I've heard and been told this by some of the providers, that EOR will protect you from creating a permanent establishment risk in country. Nexus, taxable presence, it's definitively not the case. So you need to consider who you're hiring through the EOR. So if you're hiring salespeople, it's likely that yes, you have an EOR in country, but you might also have a taxable presence, and therefore you might need to think about setting up a branch or a subsidiary in country as well. At that point, if you are forced into a position by virtue of the kind of tax regime of setting up a local entity, is it worthwhile having the local entity set up and running the EOR at the same time? Questionable. It's additional costs, and therefore what you're probably likely to do is actually port those individuals from EOR into the entity and run payroll. So yes, I don't have an issue with EORs. I think in the past I have put some articles out there and you know, was made aware that people were saying that I was being relatively negative about the use of EORs. I'm not. I just think they need to be used, but you need to be aware of the potential issues that they can face. The other point that I always raise when I talk about EORs as well is it a great idea to hire development teams or people that develop proprietary technology through an EOR? Now, it depends on the provider, fundamentally, the EOR provider. And actually looking and assessing the IP clause protections that are provided in the back-to-back contracts. Some of them are stronger than others, but the reality is that you want to ensure that if you've got developers working in country using an EOR, that you fully understand where the IP resides. You don't ever want to be in a position where you've got potentially split IP because it's locked in country. I would want to get comfortable as well that the IP fundamentally flows from the developer to the EOR provider back to the business. I've seen in the past, and this was a while ago, where there were not sufficient coverages through the kind of back-to-back contracts. And therefore, as a result, there were lawyers putting in additional IP protection agreements with the relevant individuals, which just seems to kind of almost defeat the purpose of having the kind of EOR back-to-back contracts in the first place. And again, a question I get asked a lot as well is, can we hire senior people through an EOR relationship? And I'm not hugely comfortable with having any of the C-suite per se being hired through an EOR relationship. There are kind of a number of reasons why that probably wouldn't be advantageous to the business.
Which does connect into tax residency as a secondary point. But let's come on to that. There's a question from Andre.
Yeah.
Question was, with the EOR in place and without a local entity, can you be compliant with profit allocation to the country? e.g. paying it through foreign entity, or is this not a good setup and better to have a local entity if there is any income tax payable locally?
Yeah. Okay. I think there's a bit of confusion Andre, I think there's a bit of confusion in that question. So an EOR doesn't create a local entity. What you're saying is that you've hired the individuals, you're running shadow payroll, or you're running payroll through the EOR, but you don't have presence in country. If it then transpires that actually you did have presence in country, you then need to think about, actually, to what extent do I need to think about setting either a branch or a subsidiary in that country? And once you do that, and you've determined that there is a taxable presence in country, you would then need to do some kind of profit attribution to quantify actually what the profits in country are likely to be. So
you don't get to the point of needing to consider profit attribution until you've got a legal entity in country, because there's no
or
way in
yeah,
which,
or branch.
or branch, but there's no way.
Yeah.
I guess is should we talk a little bit around the branch versus subsidiary question then, because that's kind of to some extent part of that next step, and maybe just any reflections on where you've seen the merits of either.
So just to be completely clear, a subsidiary or a local entity is a separate legal entity in country. Sorry if I'm teaching you how to suck eggs here. Whereas a branch is an extension of, say, that main entity, in my example, the UK business. So it's basically it's a representation of the UK business, say in Spain, in the example that I gave beforehand. There are benefits of having a branching country. There's the ability to offset and utilize any losses that are created in that in the branch back into the UK business. And there are certain elections that you can make in order to kind of withdraw that as well. Sometimes it is cleaner and more effective to set up a local entity rather than having a branch. You will have still, say, similar kind of filing requirements from an accounting, audit, tax perspective of which of the attributes you choose. Similarly, you may well fall into a position where, from a legal perspective, it might be more beneficial having a separate entity rather than a branch, right? The main point here is that if you have a branch, as I said before, it's an extension of the UK business, and the UK business in the example that I gave holds the IP, it holds the value. If you are going to have sales in country, then fundamentally you might well want to have a separate entity, a separate veil of incorporation between the UK entity with the IP and a sales office, sales location. In the event that anyone was ever to kind of potentially sue the business, it may be beneficial to protect the business with the IP, and therefore the exposure sits and lies with the kind of overseas entity. So that might be a reason. Other reasons why also that it might be advantageous are that, again, commercially, you might start to have customers who are starting to ask if you can engage through local law and engage directly with a local entity. So you may choose to go down that route. That'll be a customer-led decision. Separately, the business might turn around and say, actually, we want to protect the IP. We want to have separate delineation between each of our entities, and therefore a local entity might be more preferable in that regard. Branches are acceptable. I think, and you might move into a branch initially and then incorporate a branch into a subsidiary at a later stage. So the point I was going to address earlier was that you will still need to do an application, a transfer pricing application, to work out the profit attribution. And that's basically the same if it's a branch or a subsidiary. So I think, yes, there may be advantages of setting up as a branch initially in terms of kind of offsetting losses. But I think there's a more advantages of having separate legal entities, and that you then end up in a position where it might be more defensible to have subsidiaries. I generally advise clients that subsidiary seems to be the better route to go, especially if it's a route where there's going to be substance in the future.
Just slightly tangential point, but does the withholding tax considerations impact applicable to the business or their transactions? Would that impact the decision making around branch subsidiary?
It will depend on the country, quite often. So when we're looking at withholding tax, we need to kind of assess to what extent, is there withholding tax between the country in which you're setting up the branch or subsidiary versus the UK business. Generally speaking, we need to look at withholding tax on a number of different fronts. So generally speaking, it's, are there royalties, interest, distributions, dividends, and then determining to what extent actually is it more beneficial to have the setup as a subsidiary or as a branch. So it needs to be thought about. It needs to be considered on a kind of case by case basis. So there's a kind of clear answer there in regard to that.
Okay, I'm just going to bring up the structure from the start just so we can signpost where we are. So we've covered difference of trading in versus trading with, covered permanent establishment. We talked a bit around employer of record models and overseas workers. The fourth section is around tax residence. And so, if you can just maybe tackle the definitions around what tax residence actually is, and some of the areas that we see scale-ups having to think about initially, that'd be good.
Yeah, absolutely. I think tax residence is one of those things that gets overlooked quite often. And it's quite easy to implement from an early stage, but pretty hard to correct at a later stage, being honest. And it comes up under diligence all the time. So fundamentally, in the UK, we've got this concept that, a UK business is tax resident here in the UK by virtue of being incorporated in the UK, but also centrally managed and controlled. Now, central management and control fundamentally means where a business has key strategic decisions. And we can take that to mean where the effective, basically, board meetings are undertaken. Okay. Now, in most instances, if we've got a UK standalone entity, it's pretty straightforward. You have the UK board, UK entity, and therefore no real concerns around the primary taxing rights because it has to be in the UK. As we start to expand our global footprint, quite often we need to then think about, as we set up entities, where is the central management and control of those overseas entities? Okay. So let's use the example of setting up a local entity in America. So what we might do is we might create our US entity. And as most people know, when we're setting up a local entity in the US, we generally set it up as either a C Corp or an Inc. And fundamentally, we set it up in Delaware. The reason we set it up in Delaware is purely from a legal perspective that we can port it around the country, and that there are tax advantages of setting up in Delaware. It's pretty immaterial, but there are reduced rates of setting up in Delaware. So that will be our kind of guide in terms of setting up in the US. Now, the US don't have a concept of central management and control. They only have where a company is incorporated. Okay, so this isn't an IRS concern. It's going to be an HMRC concern. So if we continue and maintain a single board meeting for the UK entity, which has 100% owned subsidiary being in the US, the concern that we face is that if we don't have a separate and distinct board meeting in the US, then we may fall into a position where it's arguable that the US entity could be deemed to be UK taxable, right? Because HMRC would say, well, where's central management control of the US entity? Well, it's in the single board meeting that we run in the UK. And therefore, HMRC would look at it and say, well, if that's the case, then we think that if there's any taxable profits in the US, then we should tax it here in the US, in the UK. Now, the point to address here is that let's just be really honest. We're not come on to transfer pricing yet, but quick 101 on transfer pricing. If we've got a sales office in the US, generally speaking, there is going to be some level of profitability when we've got a sales office, either by virtue of it being a limited risk distribution model or a fully fledged distribution model. Okay. And therefore, there will be an attribution of profits in country in relation to that. Similarly, if it's a cost plus arrangement, there will be an element of profits arising in country. So it's quite often the case that our overseas entities may be profitable based on a margin or based on a cost plus mechanism. Okay. Now, what we want to do is avoid a number of different things. If there is uncertainty over who has primary taxing rights between the UK and the US, just giving this as an example, we can quite often fall into a position where fundamentally, who you look at the double taxation treaty, which is basically a treaty that exists between the UK and the US that indicates fundamentally who has those primary taxing rights. Now, unhelpfully, with the UK-US treaty, there is no tiebreaker clause, and there are others in other treaties that apply to other countries. But they've got, with the US, something that refers to as mutually agreed procedures, MAPs. Okay. Now, if you can imagine a situation here, you have taxable receipts in the US entity, and therefore you're paying taxes to the IRS. Now, if HMRC consider that there is a position where they have primary taxing rights, they may then suggest actually that the primary taxing right should be in the UK, and they'll tax you on the same profits in the UK. So in theory, you could be paying taxes in the US and in the UK on the same profits without a credit offset, okay? In order to resolve this situation, you go to mutually agreed procedures, MAPs, where you have to both get the IRS and HMRC in the same room to negotiate who has primary taxing rights over that entity. Now, I'm just going to be really pragmatic for a moment. It's not really in either the IRS's or HMRC's best interest to do that because they're getting taxable receipts. And therefore, it is quite often the case that the individuals or the tax authorities basically will not do this quickly, and they will draw this out for a period of time. I've seen instances where this can go on for 2, if not 3 years, where neither party want to really get into the room to debate it. So you can then end up in a position where you're paying tax in 2 jurisdictions, no credit offset, as I said, and that obviously is not a great position for you to be in. And again, if we're looking at it through the lens of like a diligence perspective, if you haven't set this up correctly, then fundamentally, are you paying taxes in both jurisdictions? Are there penalties and interest arising? And if you have that across multiple different countries, you can see why this becomes a concern. The next point is, once you end up in a position where you have then basically determined who has primary taxing rights and taken a view on it, and by the way, as I said before, that's going to take quite a long time. It's going to obviously incur pretty substantial accounting, tax, and legal advice. You may then end up with the position where, let's use the example again, you've got a US entity that you want to be taxable in the US, but actually it's been argued that it's primarily taxed here in the UK. If you then want to bring it back to the US again, what you have to do is you have to migrate it from the UK to the US, and there is an exit charge that will arise on that, a dry tax charge. So you want to be careful when you're thinking about residency, because whilst it's a really simple concept about how to set up and run board meetings in country, and there are certain kind of rules that need to be followed and addressed in relation to how you run those meetings, and the frequency of them and who needs to be there, and other things attaching to the board meetings, this is quite often overlooked, and therefore there can be some pretty serious repercussions. An example that I've got at the moment is where I've got a business that is looking to exit probably in the next 12 to 18 months. And they had historically set up their businesses as dual tax residents, right? Now, it's interesting because there's a new finance team there and none of them can address their query as to why their previous advisors had suggested that seemed like a sensible route. I think what happened is they'd made a mistake somewhere and then they just kind of did it and then continued that, and they set up another 10, 12 entities overseas, okay? So we have this issue now where we are not entirely sure who has primary taxing rights over each entity. Some of those entities have developed proprietary technology and therefore hold value. So we're concerned on a number of different fronts. There is concerns over how the transfer pricing application should apply across the group, fundamentally. Because it's not particularly clear as to the application of who is primarily taxable for those entities. So whenever we do transfer pricing work, we always kind of make sure that we've locked in and understood the residency position in the first instance, because it really determines the overarching tax efficiencies for the group as a whole. And then the concern here is that this has been ongoing for a number of years. So is there missed tax? Is there interest and penalties? How do we kind of get the entities back into the countries that we wanted them in the first instance? I've already been working on this for over a year, right? And it is a slow process. So at some point it will need to be addressed, and it could end up costing millions in order to kind of correct the position. And as I said before, it's a relatively simple concept. So getting it wrong in the short term, when you're initially setting up operations overseas, can have much wider impacts as the business grows and scales. And again, it's relatively simple. The application of it can apply, generally speaking, on a global basis, and just needs to be thought through.
And having that prepared and ready for diligence is really something that I think we've seen as a useful step, so that when the question comes, which is quite an innocuous question, do you have board meetings in your subsidiary entities? If you can't answer that quickly and clearly, it starts to unravel a little bit in terms of the eyes of the diligencer. So
absolutely. So yeah, and it can unravel a whole can of worms basically at that point. So yeah, I wouldn't say that. So residency will be a red flag that would need to be considered in more detail. I'm being honest. I don't think I've ever seen a deal fall over because of residency being an issue, but I've definitely seen it highly ranked in terms of the issues and indemnities, warranties, price and value chips being applied by virtue of that.
yeah,
And the problem that you've then got is that you might have an indemnity for a relatively extended period of time because it needs to be resolved and addressed. And as you're aware, it's so much easier to kind of deal with these before a diligence event than as or during or post a diligence event. But also having an awareness as you walk into a diligence. As I was at a presentation last week, and there was a CFO that was presenting alongside me, and he said, the minute that you start diligence, the game is on, right? And actually, the more you can take off the table before you walk into a transaction, the better, fundamentally.
You've touched on transfer pricing a little bit. I think that's the last section we wanted to cover. We could do a whole hour on transfer pricing, which we're not going to today. But maybe let's use different types of examples, so that I think generally speaking, we'll have people on the call that will maybe have overseas development teams, and there'll be others that maybe have overseas sales teams or overseas sales entities, etc. So maybe covering the high level on both of those sorts of structures or business models would be useful, just as a initial
of course.
pointers. Yeah.
Of course, let's take a step back before we just get into kind of the models that are applicable. So generally speaking, the application of transfer pricing might not be a UK requirement, just being completely transparent. There's an SME exemption. So if you've got less than 250 employees, 50 million turnover, and something like 43 million balance sheet, the application of transfer pricing is not required from a UK perspective. However, and there's quite a lot of companies in our portfolio that are below those thresholds, but do we still apply transfer pricing and have an approach that seems reasonable and proportionate for these businesses? Absolutely. There's a number of reasons why there is the need to think about transfer pricing at an earlier stage. So for instance, there is no de minimis limit when it comes to transfer pricing from a US perspective. So actually, if you start to sell into the US, or there is an entity in the US don't have there is a requirement to implement transfer pricing, even at a very low level. The other thing is actually it starts to create, good behaviors and governance by putting transfer pricing in place, how you're going to recharge costs. So therefore, we're not just looking at it through the lens of overseas tax authorities, but potentially from an accounts and from an audit perspective. Good discipline there. It also gives you a view in terms of exactly how the group should operate, both from a management accounting perspective, but also at year end in terms of stats, to basically give you clarity over what needs to happen at local entity levels. And the point that I sound like a broken record, but actually having consideration around transfer pricing is a really strong indicator when you're going through diligence. So quite often, we've seen instances where the wrong application of transfer pricing or no transfer pricing has been considered as groups grow and scale. And therefore you have kind of incorrect profit apportionments, or you've got incorrect margins or incorrect use of cost plus. And I'll touch on those in a little bit. So again, it's just good practice to kind of start thinking about those, as I said, from local tax authority perspective, from a governance perspective, from an accounts perspective, and from a diligence perspective. And one of the things that we do quite often is that whenever we do any work, given that we've talked about diligence so much, is actually preparing data room ready files. So making sure that you've got a consistent approach, and then regularly checking in to see actually, Is it in line with what's going on commercially in the business? Does it need to flex and change? So these are all areas that we kind of support our clients with as they grow and evolve. We know that, you know, as businesses change and grow, there's going to have to be adaptations and tweaks and appendices added to transfer pricing. We had a conversation this morning. We did a piece of work where we've got UK Topco, US subsidiary, and they're setting up a development center overseas. So yes, there is a transfer pricing model already in place, but we then need to think about adding an appendix for basically the extension into a development center.
Yeah.
I talk about transfer pricing. Can I just define what I mean by transfer pricing? Like, transfer pricing can take many different guises. Generally speaking, for scaling tech companies, you're not going to be in a position where you need to do what's referred to as master and local files, but a sensible and pragmatic and scalable approach that basically has overviews of where the risks and rewards of each entity lie, and then a sensible kind of like charge application of the transfer pricing is fundamentally what we recommend. Again, it gives you what you need. It should be signed off by the relevant auditors and by the tax authorities in that instance. There's always going to be exemptions. So as an example, in Australia, if you hit relatively low thresholds, there is a requirement to have transfer pricing prepared within a relatively short time frame. So again, just think where you've got entities. So generally, this is why we look at the residency, the transfer pricing. Do you have PE exposure in countries? They all go hand in hand with each other. Because as companies grow and scale, you just need an oversight of each of those. And hopefully this is covering those today, so that if there is a trigger to say, actually, I've not really thought about this in the past, then actually just running it past someone like, you know, myself or the wider tax team would be helpful, so that you can just make sure that there isn't exposure there. We've touched on different types of transfer pricing. There are a number of different multitudes of how transfer pricing should be applied. Fundamentally, whenever we do any transfer pricing, we always start off with what's referred to as a functional analysis. It looks at the risks and rewards that lie between each entity and really determines what the commercial overdrives are, what the supply chain between countries looks like. From that, you can then determine a number of different ways that the transfer pricing application should apply. So should it be like a calculation based on margins? Now, that's generally applicable when you've got sales teams. But if you've got developers, we'll just close this point off quite quickly. If you've got a cost center overseas, you're developing a cost center, say in Eastern Europe, then normally the application of that would suggest actually that you'd set up a local entity, you'd hire the relevant individuals, and then there'd probably likely be a cost plus mechanism engaged in country. As a general rule of thumb, it's relatively normal, depending on the seniority of staff, to apply anywhere between a 5 and 10% cost plus methodology. If it's purely a cost center, right? And that's not just developers, it's any costs in country. So just think about that. There are countries that are exemptions to that. We know that India charges, or the Indian tax authorities would look to charge a higher rate of cost plus. So again, just thinking about where you've got individuals, if you've got entities, if you need to set up entities, are all relevant for this discussion. If you're starting to think about putting salespeople on the ground, initially, you could have a cost plus arrangement with individuals who are in a sales team, but that will outgrow very quickly. So let me give you an example. If you've got individuals in country that are fundamentally just teeing up initial meetings and then passing those back to, say, a UK sales team that will substantially negotiate, conclude, and sign contracts, those individuals might actually start off with a cost plus, right? And that would be relatively normal in terms of approach. But however, I find quite often that that isn't the case, or that you're kind of going into country and doing that early stage recce quite early on. So that early stage recce, you're not really engaging necessarily with customers. You're definitively not negotiating, including contracts, but you're doing kind of market testing, market saturation, and understanding actually, will my product be applicable in country? Just be completely clear. I don't think, as long as you're not going too far, then you're not creating a permanent establishment by virtue of doing that. It's when you start to think about hiring individuals or sending people overseas that you might then trigger kind of permanent establishment risks, and therefore the application of setting up an entity. If you've got a sales office, so you've got salespeople in country, you're likely to either fall into a limited risk distribution model or a fully fledged distribution model, and there are differences and nuances in relation to those. Generally, a limited risk distribution model, there is less risk attaching to it, so that enterprise is not particularly entrepreneurial. in regard to how it works with clients. So there is less autonomy by the relevant individuals. For instance, it probably relies on a lot of support from, say, the mothership, the UK business, in order to drive those sales targets. So it relies on, you know, prescribed fee structures. The central marketing is coming from the UK business. It's not really being that entrepreneurial. And therefore, if you've got a limited risk distribution model, it's likely that you'll end up with a margin in country, right? And that can be as low as 3 to 5%. So again, you need to then think about what the revenues are creating in country, what the cost base you've got, and then that's supplemented through transfer pricing to kind of get you to that 3 to 5% margin, which would be acceptable from an IRS perspective and from an HMRC perspective, depending on the business and what's going on there. If the business is more entrepreneurial, so it has more autonomy in country, so again, you've probably got more senior sales teams that are going out and actually being more, have more enterprise in country, developing their own marketing and adapting what is coming from the UK, you might need to think about changing the model and making it a fully fledged distribution model. At that point, it's interesting to note that that is a time when you can actually generate losses initially, because obviously it's its own enterprise, it's separate and distinct to the UK business. I think you just need to step back and look at the fact patterns. Each instance is always going to be different. You may want to adapt what you're doing in country to fall into, say, a limited risk distribution model to start with before you move to a fully fledged model. The reason for that is, yes, you can create losses with a fully fledged model, but that can very quickly flip into high levels of profitability. And depending on where you're setting up entities, you can utilize those losses very quickly, and therefore think about how you're going to grow and scale in country. So again, we can have those discussions with you. It's not just a kind of one size fits all application for transfer pricing. It's about structuring what you are doing on the ground, what applications you can change, how are you growing in country, and those things need to be considered. So that's probably transfer pricing 101 in about 5 minutes.
I was going to say, we do have a 1 hour video on YouTube covering transfer pricing. So if you really wanted to get deeper on transfer pricing, then there is a session there you can go back and look for on YouTube, along with a bunch of other videos on other areas and scale ups and tax areas in particular that we've covered in the past. So do check those out. Just in terms of the final pieces here, I guess on transfer pricing in particular, what we do often see is kind of over-engineered scopes or pieces of work being done by scale-ups, where frankly they're overpaying for projects that are probably overscoped and not necessary at a certain point in the size of the business. So just be wary of what you actually need to do at each point, and as you get bigger, the requirement maybe need to be more robust with documentation, etc. But definitely worth an agile entry point in transfer pricing. Is there anything else, James, in terms of the overall international agenda that we haven't really covered? Is there anything that you think, particularly on diligence, that you see coming up as being potentially problematic before we wrap? Any other questions? By the way, put them in the Q&A now. We'll cover.
I think when we're looking at international tax, I think a couple of things that I would think about. Okay. I would think about let me just think this through. So if you're thinking about moving contracts from the UK down into a local entity, just be careful and wary of that. It's probably worth speaking to myself or a tax advisor in relation to that, because you can trigger pretty nasty tax consequences. So if you're moving assets overseas, and by that I mean also contracts, and contracts is a right to future revenue. It's basically an intangible fixed asset. So be wary if you're thinking about moving contracts, and that happens quite often when you set up a, say, US entity and you've traded with the US historically and you want to basically move those contracts across. So just have an awareness of that. There are ways of fixing it through transfer pricing, but if you lift and shift immediately, you can trigger tax charges. There are things where you're moving individuals from the UK overseas. therefore need to think about what the profile of that might look like as well. Short-term business travel is applicable there. You've got individuals moving overseas and what that might mean for any kind of share options that they might have as well. We talk about CFCs, so again, consider where you're setting up entities in relatively low tax jurisdictions. Again, something that we don't see all the time now, but in the past, I used to do quite a lot of IP offshoring, and therefore concerns are attaching to where IP was located. Yes, it has a tax profile attaching to it, but also just think about where you're developing the central IP. Do you have central IP, or do you have split IP as you're developing your technology on multiple different fronts in multiple countries? How does that look from an investor perspective in the future? Also, I've seen instances where people have done, not so much anymore, but clever IP structuring and moving IP offshore and setting up kind of complex offshore structures. But just think about what the repercussions of that from a reputational perspective when you're thinking about actually the application of future investment or an exit. I've had many instances in the past where people have done that over the last 5 or 6 years, and then fundamentally they're in a position where they want to sell the business, but it's become not attractive because actually, people don't want to invest with a Cayman topco. Again, you need to think about a whole raft of other tax considerations that are attached to that. Final point really is then kind of thinking about the interplay between companies on entities within the group and withholding tax implications that can arise. How do you enter, mainland Europe now post Brexit? And there are kind of prescribed ways of doing that. So could you go through Ireland? Could you go through the Netherlands, as opposed to going directly into country? So there's, I think the point I'm making here, and without sounding too boring, is that any commercial decisions that a business makes, there's always a tax overlay. When you're thinking about growing and scaling internationally, not only do you have to think about what the local filing requirements may be, but the interplay between the UK business and those overseas jurisdictions comes into effect as well.
Yeah. Okay. Cool. There's one last question, and hopefully we'll do it in 30 seconds. Reference to your point earlier about negotiating contracts, and essentially questions around the definition of what negotiating is, given you could be discussing it with someone, with a potential customer, but you're not actually technically negotiating, etc. And at what point does that kind of transfer into triggering the criteria around clearly trading and negotiating contracts? Yeah.
Okay, so the definition here has changed quite a lot over the last few years. This is something that the OECD has kept abreast with. So the definition used to be very much attaching to where a contract was signed, right? And that kind of gave this impression that individuals are traveling around the world with bags of contracts so that we're having them signed. I think the signing of contracts, especially using software in order to do that now, has meant that that's not so much the case. So they've kind of put more impetus on where contracts are substantially negotiated and concluded, right? Now, that's more a test. So if you've got individuals that have the ability, and the legislation clearly states habitually have the ability to negotiate and conclude contracts, then we just need to be mindful of that. So again, you may want to consider that in the context of the ability of individuals overseas to kind of negotiate those contracts. It's quite a binary definition. So, and we can risk review any of those areas. So if anyone has uncertainty or questions, then let us know. I can see we're coming up against time because I can see the numbers dropping off.
Yeah, we are. We're done on time. Thanks for joining, everyone. And if you want any one-to-ones, let us know. We spend a lot of time with people just diagnosing things they need to think about. So give us a shout and we will have a chat. I look forward to seeing you on the next one. Thank you for joining, and let us know any feedback. Cheers.
Thanks, Mel. Later.